Generally, you're required to pay taxes on your income, but sometimes when you transfer your assets to someone else to avoid taxes, this rule kicks in, which is called as income clubbing. So what does clubbing says? Many people earn in the name of their spouse or their kids, but if they are non-earning, the income will be taxable in your hands. You're allowed to invest in the name of your family members, but Income Tax Act says that the income accrued from those assets will be taxable in the hands of the transferor and not the person to whom you have transferred the assets. So you have to club that income of that particular family member into your income, which ultimately increases your tax liability. And remember, clubbing applies to both income and losses also. If you transfer the income without transferring the asset, the income will be added back to you. So for example, if I have a house property and there is rent coming from that house property, I have instructed the tenant to transfer the rent to my mom's account, and my mom will spend the rent amount on herself. So I say that this rent goes to her, so this rent is her income. But the property is my name. I have funded the purchase of the house property. So who will pay tax on this rent income, my mom or me? No, I have to pay the tax on this property income and not my mom, because I have transferred her only the income and not the asset. Let's take another example. I have bought a property and registered it in the name of non-earning spouse. Later, the property is let out. So in this case, the rent income will be taxable in the hands of transferor who actually funded the property purchase and not the person on whose name the property is registered in. When you give someone an asset in an irrevocable deed, then the income from that asset will be added back to your income. So for example, if you're giving someone a house property but with a condition that you can take back the property anytime, then you're not giving the property to that person, because that is not the permanent transfer. That is a temporary transfer which is done under a revocable deed. That is, you can revoke the transfer anytime. So whenever you are transferring any property or any asset in this way, which is temporary, even for any kind of consideration, that transfer will not be considered actual transfer, and whatever income that asset will be generating will be added back to your income as a transferor and not to the income of that person to whom you have transferred the property temporarily. If your minor child or even a married daughter earns income from the asset transferred by you, then that income will be clubbed in your income. So for example, if I have kept a FD in my kid's name, so the interest accrued on that FD will be accrued to the income of the parents. So that interest will not be taxable in kids' hands. That income will be taxable in the hands of the parent whose income is higher before adding the kids' income. However, in case of clubbing of minors income, there is an deduction of rupees 1500 under section 1032 which is available. So let's say my kids income, FD interest income is 4000 rupees. That FD was kept by me. So if that income is 4000 rupees interest income, I will be exempted for 1500 rupees and remaining 2500 would be taxable in the hands of the parent whose income is higher. Again, let's say if the interest, FD interest annually is just 1000 rupees. So the entire 1000 will be exempt, as up to 1500 is exempt. If your child is grown up, then his income will not be clubbed into years. Or if the child is earning out of his own skills, or he is doing some manual hard work, labor or anything like that. For example, my child is Sachin Tendulkar and he is at the age of 16, he is making money through his own skills. So that income what he is earning has no connection with me. So that income will be credited to his account, and that income will be taxable in his hands and will not be clubbed with my income. If your child invests the money given by you into some business or some stock market and earns more money out of his own skills or out of his own logics, out of his own talent, then also the income generated by the child will not be clubbed in the hands of the parents. Also, one last thing, in cases the child is disabled, even if the asset is transferred by parents, the income of the disabled child is not clubbed with the parents. If your spouse gets paid by a company where you have a big interest, then the money will get clubbed in your income. So for example, if I have a company in which I have appointed my wife at a salary of 1 crore and she never comes to office, the same work I would have done with some manager who would have charged me 10 lakh rupees. But I am paying here unjustified 1 crore rupees. So therefore, this income will be clubbed in the hands of the company, will be taxable in the hands of the company and not the wife. Even if I have a proprietary concern or such partnership concern, that share, if I am paying her unjustified share, then that taxability will be in my hands, clubbing will happen and I have to pay tax and not her. But if your spouse has professional skills and she is earning based on those and takes justified shares, it will not be added back to your or company's income even if you have substantial share in the company. If you transfer an asset to your spouse or daughter-in-law for a very little consideration, that is without adequate consideration, any income which is generated from that asset will be clubbed to your income. So for example, I have transferred a house property of rupees 10 crores to my spouse, to my wife or daughter-in-law at rupees 10 lakhs. So the 10 crores property I have transferred to her is at 10 lakhs. This is not the adequate consideration, right? And I say that I have sold the property to her, I have transferred the property to her. So now whatever the rent income will arrive, the rent income, she will be liable to pay the tax. But that will not happen. If you are selling the property to someone, that should be near to market value. That is, it should be for adequate consideration. And when I am transferring here without adequate consideration at a price much lesser than the market value, I will be liable to pay tax on the rental income generated from that property. Even if you gift money to your wife and she invests that money somewhere, the income generated from that investment will still get added to your income. But let's say, for example, if a husband transfers a property of 25 lakhs to his wife and the wife gives his jewelry of rupees 25 lakhs to the husband. So now here is the adequate consideration. So if the property is transferred for adequate consideration, then the rent income from that property will be accrued to the wife only and not to the husband. Even if the asset is transferred before marriage, there is no clubbing, because clubbing happens only when the relationship of husband and wife subsist at the time of transfer of the asset and also at the time of accrual of income. And if on the date of the accrual of income, the transferee is not the spouse of the transferor, there will be no clubbing happening.